Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, I gotta say, we are keeping the streak alive of the rates moving in the same direction as the weather, meaning bad. It's pretty strong correlation. I think I'm onto something. Unfortunately, rainy day. You might be able to see behind me. You might be aware. Awful day. And then rates, I don't want to say awful, but not great. So we're going to get into it, why rates are down, and then big week ahead of us, inflation data and everything else. But welcome, everyone, to the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage right here, Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I just take a month off for no reason. So I'm not doing that. So here we are doing the show. So, all right, yeah, we had the 10-year yield jump back above 4.7%, first time since the end of July that we are at this level. So it was, and I mean, literally the end of July, 31st of July, when we were last above 4.7%. Then we saw a big drop down, and then we've slowly kind of worked our way back. I think this was... Now, rates were down a little bit on Friday, but yeah, they jumped almost 5 basis points back above 4.7%. The good news is we didn't see as much movement in the 30-year, at least according to Mortgage News Daily. They had rates up 2 basis points, 6.76%. Still not a great rate. So why did this happen? Well, I think we got 2 main reasons. One, oil. This continued issue with Iran, the war in Iran, the impact that's having on oil markets, the pressure that's putting on inflation. And then, of course, on top of it, we also have an ongoing concern about not just U.S. debt, but just debt in general. Both of those, I think, are why we saw rates rise to start the week. So let's start with oil. So oil was back up above $80 a barrel. I think oil trades, 23 hours a day. It's like off like 5 o'clock or 6 o'clock Eastern time is like the 1 hour in the global markets. It doesn't trade. But I think I'm going to try and pull it up here. See where we are. Yeah, Brent's back above $87 or close to 90. Kind of a big jump today. So yeah, I mean, oil prices are rising because we're not seeing any real movement with negotiations with Iran. And there, of course, the Strait of Hormuz, not a lot of movement there as well. And then the news came out, I think it actually came out over the weekend, but I saw it, red banner on CNBC in the middle of Monday about the U.S. Strategic Petroleum Reserve. Of course, oil that, we store in case we need it. For the first time since 1983, it fell below 300 million barrels. And I mean, there's kind of a story to this. And I think I want to clarify this because a lot of people are going to, either think we had way more or way less or whatever it is. But basically, since its sort of creation, it's been on the up and up. And in June of 2011, 15 years ago, it hit the highest level ever. And that, of course, if you remember at the time, we had, sort of the oil shale boom that we saw kind of in the early 10s, late 2000s. And so that, I think, is why, we saw this sort of, and of course also the recession. And so oil prices fell. And so, it's a good time to stock up is what I'm saying. And so in 2011, June 2011, we actually saw the SPR peak in June 2000, once again, 11, 700, I've said that like 5 times, 726 million barrels is what we peaked at. So 726 million barrels. And then it remained, now it did fall below 700 million a few months later, but it remained well above 600 million for pretty much the next decade. And it wasn't until 2021, December of 2021, that it fell under 600 million barrels. So it kind of fluctuated more kind of at the higher end, higher 600s, and then kind of slowly started getting depleted. And then it fell under 600 million for the first time in December of 2021. And then out the door. Oil was out the door after that. If you remember why, so, we had COVID, we had the COVID spend, inflation skyrocketed, and then President Biden, to help consumers, started using the reserve to put more oil in the market and lower prices. And boy, did they open the floodgates. So in 18 months, so from December of 2021 to June 23, they went through 347 million barrels of oil. 42% of what was in there was depleted. 42%. So it was, it was right around 347 million is what it ended up at. And then after that, we saw it rise again, and it got above 400 million. And then the war started in March, end of February. And then that's when we started seeing it depleted again. And so now it's fallen under 300 million. But it should be noted that the drop from the war to now, so 6 months, was about a 28% drop. We went through 100 million barrels in 6 months. But remember, it was the 18 months where we went through 300 million, which, to be honest with you, is about the same pace. The percentage is bigger because, the number was smaller to start with. But in 18 months, we went through over 300 million barrels of oil, or almost. And so we're kind of on that same pace. So yeah, the war has been bad for the strategic reserve, but it was made worse because of the oil that we used during that inflation, the really bad inflation situation. And so that's how we got there. So it's important to look at it because a lot of people are going to say, oh, it's Trump's fault or it's Biden's fault. It's both their faults is my point. The whole reason we have the reserve is to use in situations, like this. And so, both presidents can make that argument. But Biden, dropped it by almost 50%. And then Trump's on path to drop it by 50%. So my point is it's both their fault. I know it's both sidesism, but it's kind of both their faults is my whole point. But so the reason that this matters is because, once again, the reason that we can use that oil, that's why Biden used it, was to relieve inflation pressures by lowering one of the most important products for the average person, which is gasoline. And if we get to the point where we can't use it, there's a level that we're going to just not want to do that to, because we're going to want to hold a reserve for, who knows what, then the president can't do anything to alleviate higher prices. And so then we're already kind of at the mercy of the market anyway, but even more so. And so then the administration not having a lever means more than likely prices are going to go even higher. And so I think that's why you saw people pricing in those higher prices because of that announcement from the reserve, which I think was either on Friday or over the weekend, something along those lines. So that's definitely not going to help rates. And then also the ongoing debt situation that everyone is dealing with. Japan, of course, probably being the number one cautionary tale with debt to GDP at 250%. It's just insane. To the point where they need the United States to help them. and the reason they're having a currency problem is because this is, of course, the argument from Robin Brooks, is that they're not allowing their interest rate to rise like it should, to reflect the risk that is Japanese debt. So they're artificially keeping rates low. So the markets are reacting with the one thing they can control, which is currency. So inflation is happening through currency devaluation instead of, so you're getting inflation because of that, is my point. Instead of them, which they should be doing, which is raising interest rates because they have a debt problem. Robin Brooks argues they have a debt crisis. But this is not just a Japanese problem. It's a China problem. It's a U.S. problem. It's a Europe problem. We're now experiencing the hangover, and we have been experiencing it for a while from COVID. And once again, Brooks writes about this, that we never got back to where we were pre-COVID. Like the U.S. budget, for example, running a $2 trillion deficit. I think when Biden took over, or no, not when Biden took over, when Trump's last year before 2020, I think we were running a $1 trillion deficit, and we just doubled that. And that's now our baseline. $2 trillion every year. But that was pretty much the argument that I saw this morning through various outlets. Bloomberg's Greg Ritchie, Michael McKenzie, and Yi Ji reported on Sunday that Treasury Secretary Scott Bessent appears increasingly focused on preventing long-term Treasury yields from moving substantially higher, noting that, one, their yen intervention was a sign of that. And then the Treasury made a subtle change to its quarterly borrowing guidance that investors interpreted as an opening the door to potentially reducing future sales of longer-term debt. They see that as, interest rates eventually are going to fall. We don't want to be issuing long-term debt in a high-rate environment because then we're on the hook on that for however long that debt is to the maturity of that bond. So let's not issue debt. So they're just convinced that rates are going to fall because otherwise, why not do that? Taken together, Bloomberg concluded that Bessent appears to be using the tools available to him to contain long-term borrowing costs, which is a big issue, especially for voters, because it does impact, car loans and credit cards, and most importantly, housing with mortgage rates, as we talk about here on the program. The problem isn't limited to the United States. Robin Brooks, who I mentioned earlier, argues that the global COVID-era debt binge, increasingly loose fiscal policy, and geopolitical instability are combining to push long-term government bond yields higher across the globe. Everyone is facing higher borrowing costs. Brooks believes governments will increasingly pressure central banks to prevent yields from rising too far. That, however, could create a new concern about central bank independence and increased demand for traditional safe havens, such as gold and currencies that people see as being safe. So maybe the dollar, Swiss franc, others. Debt problems are also beginning to surface in the private markets. Wall Street Journal reported on Monday, Matt Weirs said that recent quarterly results from some of the industry's largest funds show weakening loan performance and investor returns. And so basically we're just seeing concern about debt overall. The government debt is a bigger issue for our world with regard to the 10-year and the impact that it has on the 30-year fixed. But we're seeing concerns about debt across the board, government debt, and then the private sector. And we're seeing massive issuances. In fact, I saw something in Bloomberg where it's going to be, we're looking at potentially a record-setting year for like high grades. This is like strong companies. It's not, junk bonds. Strong companies issuing debt, like record levels. And a lot of it, I think, has to do with AI and them needing more capital in order to invest in AI, this sort of AI arms race that we are seeing happening in the world. So debt and oil, I think, are the reasons why the 10-year was up about 5 basis points on Monday. And then before we go, we did see some confirmation. So if you remember last week, it was reported, I think it was Nick Timmeros, who said that Trump has been talking to Warsh regularly. Trump dismissed that, saying that he is not talking to him regularly, but did say he talked to him recently, telling reporters, quote, that he had been in touch, quote, one time briefly a few days ago. And so he is not confirming that he has been in contact with Warsh, which would be somewhat uncommon. Usually the president's kind of let the Fed do what the Fed's going to do. Trump is not that, as we know. I think it was also reported on Friday that Trump's trying to go after Lisa Cook again. But we know that Trump's not your normal, typical president. And so he has been open with him wanting to kind of shape the Fed, but he did deny talking to him frequently. So interesting to see if there's proof of that, which probably is unlikely because it would either be Warsh or Trump. And I doubt either of them is going to say anything to the contrary. But I mean, I don't know why he wouldn't just admit it if he was doing it, though. Like, what does he care? I mean, the way he went after Powell, I mean, he doesn't really care about upsetting the apple cart with regards to tradition and the way the president's supposed to interact with the Fed chair. So, I mean, it kind of makes me think he hasn't been talking to him frequently because he kind of denied it. So, all right, that's it. That's all we got. It is a big week, though. I told you it's a big week. We got CPI, which I believe they're showing is supposed to be another negative month. So June, of course, we had the bigger than expected drop. They're projecting another down month for at least the top line number. I think core's still supposed to rise, but less. And then not a lot of change year over year. But as always, all eyes are going to be on it. And we're seeing bond moves negatively going into the report. So we shall see. We'll see what happens. But we'll talk about it on tomorrow's edition, Wednesday's edition of Wilmington Mortgage. You guys enjoy your Wednesday. And remember, as always, or Tuesday. Today's Tuesday. Because remember, as always, do not wait to buy real estate. You buy real estate and wait.